Hey everyone, and welcome to this explainer. Today, we are diving into a deeply practical, entirely data-driven thesis on the 2026 Kansas City rental market. Look, if you are a real estate investor who already owns property here, or maybe you are actively considering jumping into this specific market, you know that having accurate, on-the-ground information is literally your single biggest asset. The national headlines almost always miss the local nuances. So today, we are going to unpack exactly what the local forecast looks like. We are relying strictly on the data and the real operational realities to help you make informed, highly strategic decisions for your own portfolio. Now, real quick before we jump right in, it is important to state clearly that this explainer is strictly for educational purposes. The data, the market trends, and the operational strategies we are going to discuss are just meant to empower you with knowledge. They absolutely should not be taken as legal, tax, or investment advice. Always, always consult with your own designated professionals before making any financial moves. Okay, let us get to it. Here is our roadmap for today. We are going to cover 5 key areas. Number 1, the Kansas City market outlook. Number 2, drivers of rental demand. Number 3, rent and vacancy expectations. Number 4, risks for real estate investors. And finally, number 5, mastering market execution. Let us start right at the top. Section 1, Kansas City market outlook, a position of strength. When you look at the national landscape of real estate investing right now, very few places offer the unique blend of stability and opportunity that we are seeing right here. But you have to understand the critical jurisdictional nuance, because Kansas City actually straddles a state line. If you compare the Kansas side versus the Missouri side, it reveals a massive practical advantage for property owners. Specifically, the state of Missouri lacks rent control. For investors, this provides a level of operational flexibility and long-term predictability that is frankly becoming really rare in other major metropolitan areas. It firmly allows the actual market, rather than restrictive legislation, to dictate fair pricing based purely on local supply and demand. That is a massive defensive moat for your investment. And the core market fundamentals here form basically a perfect economic trifecta. First off, home prices in this metro remain well below the national average. When you pair that distinct affordability with exceptionally healthy rent-to-price ratios, well, the mathematical reality of cash flow actually works. In those highly inflated coastal markets, your yield is often compressed down to practically zero. But here, the rent genuinely supports the asset. Add to that continuous, sustained population and job growth, and you have a totally undeniable foundation. These fundamentals are exactly why the metro area consistently ranks near the top of national lists for affordability and reliable rental yields. Moving right along, Section 2. Drivers of rental demand. The catalysts. A market is only as strong as the jobs and the people flowing into it. And right now, we have simultaneous catalysts driving the entire Kansas City region forward all at once. Take a look at the multi-billion-dollar Panasonic EV battery plant over in DeSoto, Kansas. This single facility is not just some flashy headline, it is actively bringing thousands of new manufacturing, engineering, and operational jobs to the area. On top of that, you have major technology data center investments bringing an additional wave of high-wage, reliable employment into the local ecosystem. And then, check this out. Kansas City is hosting the upcoming 2026 FIFA World Cup matches. That is going to draw a massive influx of global tourism, rapid infrastructure improvements, and international attention. When a city experiences industrial, technological, and cultural booms at the exact same time, the metro predictably adds residents, and those new arrivals generally need to rent before they decide to buy. It is simple math, really. More jobs plus more residents equals sustained rental demand. Which brings us to Section 3, rent and vacancy expectations. The base case. So what does all of this macroeconomic growth actually mean for the monthly cash flow of your rental property? Our base case here is highly practical and grounded deeply in the data. Rather than betting on some dramatic speculative boom or, on the flip side, worrying about a devastating crash, we are confidently projecting continued moderate rent strength and manageable vacancy. If you own a well-priced and well-maintained home in this market, you should expect steady tenant demand and gradual, sustainable rent strength. The fundamentals support a remarkably reliable market, not a wildly swinging pendulum. And honestly, boring is beautiful in real estate. This is exactly the kind of predictable, resilient environment where smart, long-term wealth is built and protected. But to be truly objective analysts, we have to pivot for a second. We have to ask ourselves an incredibly important question. What are the risks? What specific challenges could disrupt this positive outlook? And more importantly, how can you effectively prepare for them? That takes us into Section 4, risks for real estate investors, underwriting conservatively. Because as we all know, no economic forecast is an absolute guarantee.
you have to carefully monitor the external risks. Interest rate fluctuations can change your fundamental cost of capital basically overnight. Broader macroeconomic conditions can temporarily impact tenant employment, and unexpected shifts in local housing supply can definitely increase competition for renters in specific neighborhoods. The crucial takeaway here is that the economic catalysts we just unpacked are massive tailwinds, but they are not guarantees. You must always run realistic numbers and conservatively underwrite each and every deal. Never, ever rely on general market trends or the distant hope of appreciation to bail out a badly structured purchase. Using a rigorous cost calculator, stress testing your vacancy assumptions, and planning for the unexpected is exactly what separates the professional investors from the amateurs.
Finally, Section 5, Mastering Market Execution. Fundamentals over timing. This is where the rubber meets the road. This proves that local property management execution matters far more than national macroeconomic trends. Having the right market is really only half the battle. Managing the physical asset properly on a daily basis is where your actual profit is made. Let us look at some real numbers to back this up. Across a portfolio of more than 250 homes, Alpine Property Management Kansas City maintains a massive 96% occupancy rate versus a remarkably low 4% vacancy rate. Alpine has carefully tracked and operated in the Kansas City rental market for more than 12 years, serving investors diligently since 2013. Maintaining that high of an occupancy rate across a robust portfolio clearly shows the sheer power of buying the right asset and pricing it accurately to the local comparables. It is entirely about matching the right home to the current local market demand. But wait, high occupancy is completely meaningless if those tenants are not actually paying, right? Well, that high occupancy is incredibly well matched by an impressive 98% rent collection rate, with only a tiny 2% uncollected. This metric proves that meticulous, rigorous tenant screening is absolutely vital. You simply cannot turn abstract market strength into real returns with reliable tenants who pay their rent on time every single month. Achieving a 98% collection rate requires deep background checks, verified income screening, professional management systems, and flawless daily execution from a dedicated local team. Now, perhaps the most striking operational advantage for an investor is this number right here, 14. That is Alpine's average vacancy rate in days. Keeping unit turns incredibly short is the ultimate operational advantage. Let us unpack the math behind that for a second. Every single day a property sits empty, you are actively losing yield that you can never get back. By getting a property inspected, cleaned, potentially painted, and re-leased in an average of just 14 days, Alpine effectively ensures that investors capitalize on the market steady demand without losing their precious cash flow to dragged-out downtime. Speed of execution directly protects your bottom line. I think Marcus Painter, the founder and owner of Alpine Property Management Kansas City, really hits the nail on the head here. He says, the advantage in this kind of market does not come from betting on a boom. It comes from execution. Your long-term success as an investor in the Kansas City market is fundamentally built on execution. It is about buying the property right, pricing it strictly to the local comps, keeping your vacancy windows short, and screening your tenants exceptionally well. It is never just about trying to perfectly time the market cycle. So, what does this all mean for you? The data is abundantly clear. Kansas City is uniquely primed for steady, reliable, and fundamentally sound growth moving into 2026. The real question is, will you let the inevitable complexities of the market sideline your growth, or will you partner with operators who consistently turn those very complexities into reliable cash flow? The opportunity is absolutely here, but the execution is entirely up to you. For help managing your Kansas City rental property, call Alpine at 816-343-4520 or visit alpinekansasscity.com.